안녕하세요. Greetings, this is David Wong, Senior Equities Investment Strategist for AllianceBernstein. And it's my pleasure to bring you our fourth quarter equity market outlook for the US market. This quarter has been associated with a return of volatility to equity markets after almost a straight line up since the pandemic began in April of 2020. We'd like to share today our thoughts on how investors can navigate what is an increasingly still positive but also slightly less attractive outlook for the US economy and for the global economy as we enter into 2022. Now, when we look back on the first three quarters of 2021, it has not really gone exactly according to plan. And while we have seen certain segments of the markets, like commodities, for instance, oil, do very well this year, there was an expectation at the beginning of 2021 that this was going to be the year for value equities, for cyclicals to continue to rebound, making up for many years of underperformance. And in the event, we actually have not seen a huge discrepancy in terms of growth versus value in 2021. What has really made a much bigger difference for clients and investor portfolios is if they did not allocate to the US or to developed markets and focused instead on emerging markets, particularly on China, which, as we can see from this chart, suffered significant underperformance and negative absolute returns in the first three quarters of 2021. This occurrence, though, at least in terms of what style to use and deploy in particular parts of the market cycle, is not as much a surprise to us at AllianceBernstein. We've generally found, looking back through economic and financial market history going back to 1991, that there are certain styles that tend to work best at certain stages of the economic cycle. And we can measure that economic cycle in the US context by looking at the ISM Manufacturing Index. Typically, when we see that the economy is recovering and the ISM index is essentially going from a below 50 reading to above 50, that is what we associate as part of an early stage recovery after some sort of economic contraction. And in a recovery stage, the types of strategies and styles of investing that tend to work best are small cap, cyclical value, as well as defensive value strategies. And this tends to be not as good for growth, momentum, or quality oriented strategies at this point in the cycle. However, as the ISM Manufacturing Index really kicks into high gear, and importantly, after we start seeing something of a moderation of economic activity, where PMI readings remain above 50, but where it is coming off of a peak level, that is what we would typically associate with an investment regime where growth and quality tend to work best. And certainly that's effectively what we have seen for much of this year after about April of 2021. And sure enough, that has coincided with the types of activities and readings that we've seen from the US ISM Manufacturing Index. Given that we don't really anticipate that the US economy will actually go into outright contraction anytime soon, we think that it is reasonable to continue to allocate into growth strategies as well as into quality ones, because what we know about the economic environment that we face as we enter 2022 is that growth is moderating. That is probably the story of 2022. And furthermore, that when we look at the biggest challenges to global equity markets, they are essentially around how companies manage inflationary pressures, whether it's in their supply chain or just the cost of their manufacturing or service. And we do think this is why quality tends to work very well in moderating economic environments, because that also happens to be when you really need to have some amount of pricing power that allows you to maintain your profit margins. Now, there are people that would suggest that because we are now seeing rates go back up, albeit quite slowly and modestly, that this is the time for value. And while value may work episodically, what we have seen really since the global financial crisis is that value rallies have occurred in the marketplace, but that they tend to be relatively short-lived. And so when one is making your long-term asset allocation decision, it may still be worthwhile having some value exposure, but we tend to believe that to address the market opportunity that we see in front of us and what we expect will remain the case for years to come, is that a more growth-tilted strategy may work more of the time. We do see in this particular chart that when we see a significant change in the 10-year US Treasury yield, we do see more extended periods of value outperformance. However, we would also make the case that at least at AB, we and our fixed income team do not expect, say, another 100 basis point hike in the next 6 to 12 months on the 10-year US Treasury because of other moderating impacts other than the reduction of quantitative easing operations, such as, for instance, foreign buyers coming into the markets to take advantage of the interest rate differential between the US is higher than, for instance, Europe or Japan. On to also the fundamentals. We've spoken about how inflation impacts central bank and monetary policy on the previous page, and also how we can see inflation ultimately has an impact on price and on the type of equities that work. But we would also like to talk about earnings. This year, and certainly the back half of 2020, saw a very significant shift in market leadership. From about the fourth quarter of 2020 through to the middle of the second quarter of this year, we saw value strategies, which are represented by these light green bars, doing significantly better. And you can see that after growth massively outperformed value for most of last year from a fundamental earnings perspective, by Q2, it was very clear that value stocks were enjoying better earnings growth than the more consistent growth strategies and companies. And this has carried on into the third quarter, we expect, and probably into the end of this year as well. However, we do think that value strategies, while they may be cheaper, they are also typically cheaper for a reason. And the businesses that they own are inherently less forecastable and hence tend to have lower earnings multiples. Their cyclicality is often also the result of lesser pricing power or more macro dependence. And as such, we think that there is more variance possible in the earnings growth estimates and outlook for the rest of this year, as well as for 2022. In fact, even consensus estimates expect that by the second or third quarter of 2022, we should see growth companies' earnings growth beating that of value companies again. And given that the markets tend to discount this 6 months in advance, and that's certainly how it played out over the last 12 months, we think it is appropriate, especially given where we are in the economic cycle, which is moderation, as is our expectation. And that really calls for more of a quality growth bent. We think that the concerns over modest rate rises should actually be more than offset by the desire to own companies that have greater pricing power and a greater control over their economic and earnings destiny. And we find that growth companies have more control over that when we look into next year and all the uncertainties about whether or not inflation remains transitory. Now, what we typically also find is that in the mid-cycle, markets are driven by earnings growth, not by multiple expansion. During the initial stages of the pandemic, we saw that the rebound from April 2020 onwards was really driven by hope and expectation that the market would stage a fundamental recovery. And that proved to be the case. But what that meant is that the share price appreciation that we saw for a lot of 2020 after the big sell-off in March was really based on PE multiple expansion or valuation multiple expansion. Whereas this year, we are seeing something quite different. There has been already a modest reduction in PE multiples that we anticipate could very well continue. But that the performance overall for the market is driven more than anything else by EPS growth. And that's really why, because we don't think that this economic cycle is ending next year, investors really should care about where their earnings growth is coming from and how predictable it is, because that is really going to be the true driver of performance of equity markets as well. And you will do best in companies where the earnings growth is not only strong, but where it is stronger than the market expects. This is also why, although we think a quality growth strategy is a sensible way of allocating money at this point of the market cycle, that one should be cautious on very expensive dream stocks. And so if we look at this chart on the left, it takes a little bit of explaining, but the key question you need to ask yourself is, how much of the value of a company that I'm buying today is really based on future earnings and how much is based on cash flows that are being generated today or in the near term. And so for a long duration equity, that would be a company like a Tesla, for instance, which has most of its earnings, according to analyst estimates, coming in the years 2030 and beyond. And for these types of businesses, because so much of their value is in the future and not as much in the present, while they may in fact be able to generate those earnings someday, that someday is not yet arriving. And when you increase rates, you are essentially requiring the market and investors to discount future cash flows 10 years from now at a higher rate than before, which translates into lower multiples. And so these types of businesses that are what we call long duration dream stocks, they tend to have more rate sensitivity than would a company that simply had a lot more of the value coming from present day cash flow generation. And so we think that while investors should be investing in growth, they need to be disciplined on valuation and on how much stock effectively they are putting into cash flows that are not going to be realized for another 10 years. After all, the zero rate regime that we've been in has been something of a time machine, but the increasing rate environment may mean that we are coming back from the future to the present. And for that reason, present day cash flow and earnings generation is critical to investment success in this environment. And this is really the point that we're making. If we look at a Tesla, its performance over the last 2 years has been really quite dependent on the rate environment. It seems, in fact, quite negatively correlated to the Treasury yield outlook. And so if our outlook is that the US 10-year Treasury yield over the next year or so will see some modest increase again, then this is not going to be great for some of these long duration dream stocks. Now, does this outlook for the Treasury rates to start seeing some upside mean that we shouldn't invest in equities? Actually, no. When we look at the last time there was the so-called taper tantrum, which was much less well communicated than the Fed by the Fed than is this one that we're about to experience in the next few months. We found that the daily max drawdown of the US market was about 6%, which, by the way, was better than any other equity market. However, the outcome for the markets after the announcement occurred ended up being a pretty strong total return that year. So we do not think that there's any incompatibility between a rising rate environment and getting positive absolute returns in equities. After all, the only reason that rates are going up is because there is more positive economic news. However, we do think that one just does need to be cautious and not take too much risk either on valuation or on earnings growth. And while the QE reduction that seems to be very likely by the Federal Reserve seems imminent, what the market is becoming increasingly focused on is when will that QE program end? And after it ends, when would the Federal Reserve begin rate hikes? Now, this may not be anytime soon. Even more hawkish commentators only expect rate rises in the second half of 2022, and only if inflation remains stubbornly high. I think the market consensus today, and it is also our view at AllianceBernstein, is that 2023 is when the first rate hike may be likely. Let's remember that rates are incredibly low today, and that a monetary policy remains very easy. However, we should not fear the impact on earnings growth of higher rates, because as we can see here, the average performance for equity markets, at least for the US equity market, 1 year before as well as 1 year after the initial rate hike, remains generally quite positive. There's also quite a lot to like about where we are simply based on the length of the business cycle. The average business cycle has, over the post-World War II period, lasted about 5.2 years. The current one is only about 1.3 or 1.4 years old. And so we think it would be completely premature to be talking about this business cycle ending, just as we think it is really getting going. All of the constraints on the global economy, or most of the constraints today, seem to be supply side related, at least in the US. And as some of these supply related bottlenecks get resolved, it is reasonable to expect that there will be another leg up to US and to global growth, especially as the world continues to recover from the COVID-19 pandemic. We would say, though, that the developed markets have performed better this year, partly because they've gotten through the pandemic faster than emerging markets, but also because they've had much stronger monetary and fiscal stimulus. The US in particular has enjoyed very, very strong support, and we do think that while this support is now going to be gradually withdrawn, it is not going to be like the Federal Reserve or the US government is going to be slamming on the brakes. There will still be deficit spending by the US government, and the monetary policy settings in a big picture perspective will still remain loose, albeit a little bit less loose than before. We think that is generally supportive of a relatively resilient U.S. equity market. And while there may be periods where performance stalls, if ultimately we have confidence in the economy and also in earnings growth to continue to rise, this has always been a recipe in the past for performance over the longer term. We would also say that U.S. equities as an asset class remains one that has a unique feature that no other equity market enjoys, which is corporate share buybacks. If we look at how much shares have been bought back every year by companies, this number has now gotten to a very high level. This year is expected to be somewhere between $700 to $750 billion of executed buybacks by U.S. corporates alone, and this number is expected to rise next year. Consider that even in a bad year for U.S. equities, the amount of outflows by investors only tends to be about $300 or $400 billion. And you realize that this explains a fair bit of the asymmetry of return and risk in the U.S. equity market compared to other markets. And the return on equity advantage that the U.S. market has, which we'll speak about shortly, over other equity markets such as Europe, Japan, or emerging markets, comes in part from the willingness of corporate America to reduce the number of shares in issue. And when we look then at the ROE, the typical objection that investors have, which is that the US is more expensive than every other market, starts to make sense, because when we look at index valuations for the US compared to every other major market around the world, the US continues to offer a best-in-class level of return on equity. And if we think about what a share buyback really does, is it makes the remaining shareholders own more of the company. And so there is something fundamental about this EPS growth that is occurring, and why US equities sort of enjoy something like a QE program that never needs to be taken away and will continue even when other forms of public sector supports are being gradually removed. Now, speaking of valuation, though, there is always this perennial concern that the US equity market is expensive. Now, anytime one says that an asset class is expensive, you need to ask, compared to what? And when we compare it to, say, the US Treasury market or to US credit, equities actually remain the cheapest major asset class, at least in a US capital markets context. And furthermore, if we compare how the PE level as translated into basically an earnings yield look compared to previous moments in the market, when we can compare it to, say, the yield offered by credit of investment grade corporates in the US, which is essentially what the S&P 500 would be, we find that the implied PE of what we are seeing in the credit and bond markets would imply a 31 times multiple. Now, we don't think we're going to get there, but we would just make the point that because equities are both expensive relative to its own history, but also at the same time the cheapest asset class on a relative basis, there continues to be a reason to own it, especially when, if one takes the view that inflation could remain elevated for some time and fluctuate between a 2% and a 4% level, one needs to get higher absolute returns to get even a positive real return after taking inflation into account. And equities, again, tends to be the one asset class that can deliver incremental nominal growth that may result from a more inflationary environment. We would also just point out that technology and healthcare as sectors tend to have higher pricing power. And that's why they tend to have higher gross margin levels than some of the other businesses that might be a lot more competitive, like transportation or autos, for instance. But we also care, as we spoke about before, about pricing power and how much it matters in an inflationary environment. And for that reason, we think looking at the variability of this profitability is also important. And so we want this number on the y-axis to be low, but we want the number on the x-axis to be high. And the types of businesses that tend to look the best in this regard tend to be the ones that are on the right side of the page, and what you typically find in a U.S. equity growth portfolio. Now, healthcare typically does also offer some amount of growth with defensive characteristics, since people need healthcare regardless of the economic environment. What is nice about healthcare today, though, is that it is trading cheaper than the overall market. Now, some of that cheapness today comes from political uncertainty, because that is the risk that one takes when investing in healthcare. But we find that many of the healthcare companies that are trading at discounts, we think are unjustifiably cheaper, because we think some of the risks that the market imagines, for instance, universal healthcare, will not come to pass anytime in the near future. We would also say investors may want to consider other opportunities in developed markets, because one issue that we need to just monitor closely is the potential for increases in corporate tax rates. This would only return it back to levels that were actually lower than what they were before Donald Trump came into office several years ago. However, we do think that it is sensible for investors to also consider some global strategies while maintaining the U.S. as their main exposure. And my argument for having the U.S. be the basis of an investment portfolio is really laid out on this page. It has the lowest max drawdown, it has the best annualized return, and it also has the lowest level of volatility. So you're getting the best returns with the least risk, at least when we look back at the last 10 years. And we've certainly learned the hard way in 2021 that you really buy emerging markets and China at your own risk. And the risk-adjusted returns from those markets don't tend to be great over longer periods of time. So we would continue to recommend that the U.S. be the majority of any investor's equity investment portfolio. Well, that really ends my sharing for today. It's been a pleasure sharing our thoughts on the markets with you, and we wish you the very best for 2022.